Welcome, guys. Thanks for attending. Hope you guys had a decent market day. This is our webinar on writing options. The big fundies out there love to write options, and we're going to tell you guys sort of how they do it. We're not going to give you 100% the nitty-gritty, but we're going to give you a couple examples, and also, go through the basics on how writing options is used and how the big guys are actually net sellers in general. And again, this is thanks to MarketFi, Benzinga, all our affiliates, and SangLucci.com. Usually we run this together between Lucci and myself, but we're going to go ahead and just let Lucci run with the content. He's got a lot of stuff here for you, and go ahead and ask questions, but just know that we're going to answer them at the end of the webinar. I'll get to as many as possible. So without further ado, we have Lucci himself here for you.
All right, what's going on, guys? Now, just to clarify here before we continue, this is not just writing options. This is writing options for Time Decay on Thursdays and Fridays. Okay, it's using the extra expirations that we now have because of all these weekly options. Okay, so as we said in our previous webinar when we talked about trading Apple weeklies, they open a lot of weeklies in advance. So take a look at any option on Apple. You'll see several open it. You have tomorrow's expiration. You have the January 4th expiration, which we'll get to eventually. So January 4th expiration. Then you have the January 11th expiration. Then you have the actual expiration for the monthlies, which is January 19th. And I think they open one more. I'm not sure. Maybe they do. Maybe they don't. Let's see. And it looks like, wow, they open. Yep, January 25th. All right. So these weeklies are open for January 25th too. So now, when it comes to actual expiration for these weeklies, or if you're talking about monthlies, okay, there is a big opportunity to capitalize on time decay because the time decay saps right out of the option very quickly on a Thursday or on a Friday. Now, I'm gonna go ahead and show you several examples, but first, let's get down to the nitty-gritty. All right. So for the basics here, what the hell is writing an option? And oh, by the way, I do have to put a little disclaimer out. I tend to swear a lot and use kind of, a lot of cussing and bad language. So if you guys are at work or, you have your kids around, just a quick disclaimer. Hopefully you guys don't mind too much. But again, that's part of my style. So let's talk quickly about writing an option. Most of all of us with smaller size accounts, 10G accounts, all you guys that are starting out with $5,000 accounts, you guys are in the market to buy these options. You're going long these options. So let's have a quick discussion about going long a call or a put versus shorting that actual call or a put. Okay, it's two different things completely. Just like shorting an equity versus buying an equity. So let's take this 520 call here. Let's say, remember this thing expires tomorrow, and let's say at the close you said I wanted to go ahead and get long this option at $1.55. Right? So you bought 10 contracts at $1.55. Now, what needs to happen for you to make money on this call? Okay, a couple things need to happen. Number one, the stock needs to push towards this strike price, and then well before the expiration date, which coincidentally happens to be tomorrow. So this thing better get moving towards 520 if you hope to sell this for any extra value. So if you want to sell this for $2, this stock needs to go to like 518 or somewhere close to 520 for you to sell this at $2. Remember, the option needs to go higher in price for you to sell this thing for a profit. All right? Now, if I'm writing the option, it's basically the converse. I'm betting against you. I am betting against all the people that are betting that this strike price might happen. And for whatever reasons, for the same reason that you might be going long this thing, I might be going short this thing. I might say to myself, I might take a look at this chart or take a look at this tape and see there's underlying weakness and say, you know what? All these calls above 520, they're going to expire worthless. Okay, now let's talk about that for a quick second too. What does expire worthless mean? All right. So if let's say chump A, who we got in here? Let's say AK. AK here is buying this option for $1.55, and then we have another guy. We got Victor. We got Victor saying, all right, you know what? I am going to sell against you. I'm going to bet against you, AK, because I don't think you know what the hell you're talking about. So I'm going to sell you those contracts at $1.55. So it's just you back and forth here. All right, so somebody's betting against you, and usually these are the right. This is the house. This is the house or the game at the casino. Okay, they're usually the ones that are writing us all these bets, so that we're the ones left on the hook for the stock to do X, Y, and Z. It's much easier to bet on a stock doing nothing or not go to a specific strike price than it is to bet on an actual move in a stock. So, for example, you calling out, let's say, a 50-point move in Apple is a lot less probable than you betting against all those people that are betting that 50 points is going to happen. Okay? So, when you're writing the contracts, let's say you wrote 10 contracts to AK at $1.55. Now, you are taking in that premium. Okay? And that premium is the most that you can get out of the trade. Okay? So let's just do a quick example. You got 10 contracts, and you wrote them at $1.55. Now remember, each contract represents 100 shares. This is all basic options. So you're going to take in premium of $1,000. Let's see, it's $1,500 and 50 bucks. Okay, so that's the max gain that you can hope to make out of this. Remember, all you're hoping is for this option to go to zero. If it goes to zero, you make your max profit of $1,550. Now, can you get out of it before that? Of course, of course. We are in the game of moving in and out of options very quickly. So just like AK is hoping to sell this $1.55 option at $2 and make 45 cents a contract, which would be 450 bucks on that trade, you can get out of a right just as easily as you can get out of a long. Okay, so let's say you wrote $1.55 and the option gets down to $1. Okay, you cover this option at $1. That means you make 55 cents a contract, and 55 cents a contract times the 10, you make 550 bucks. Okay, it works just the same. There's only one difference here. Okay, one requires margin and one doesn't require shit. Okay, so when you buy your 10 contracts, when AK buys his 10 contracts at $1.55, how much money is he expending? Okay, so let's say AK buys 10 contracts at $1.55, and that costs him $1,550 bucks. He is taking cash, $1,550 out of his account to buy these contracts. Now, what's the flip side? Now, this is where it gets dicey, and this is where it gets tricky for a lot of you players. Now, what's it going to cost you to write 10 contracts at $1.55 of Apple? Okay? Now, unfortunately, if you're going to write these naked, okay? Now, naked means with no cover, okay? So now let's assume bare minimum you guys are going to write this naked. Now, what your broker wants to know is if you have the cash available to cover that strike price if things go wrong. Okay? So that means they want to see that you have 10 contracts times the exposure, which is 100 shares. So effectively you have exposure to 1,000 shares. Now how much does 1,000 shares of Apple cost at whatever strike price? You got at 520. Okay? So at 520, how much does that cost? That's $520,000. Okay? Your broker wants to know that you have 25% of that total amount. Okay? In order to even write 10 contracts, you need to have 25% of this $500,000, which is, let's just ballpark this, at $125K. If you do not have $125,000 cash in your account, you cannot write 10 contracts of this Apple 520. You cannot do it. Now that's provided if you're naked, okay? If you're naked and you have no cover, okay? So now we're going to talk about spreads in a minute. So I want to get this out of the way before we actually talk metrics and how the hell you're going to start writing these things, okay? So again, if you ain't got $100,000, $200,000, then you're not going to be able to write naked. You're not going to be able to write these things at all. Hence why it takes a lot of us out of the game. Okay, most of us can't do that because most of us don't have that kind of money. And let's be honest here. You're going to spend a margin of $125,000 to make what? 1,500 bucks? That's what you're going to make off that? And again, it goes back to the house. Okay, you go back to the casino. They're making a very, 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 very small margin on all their bets, but they're killing it on all these bets. Okay, that's their game. And again, that's the house's game when it comes to writing options as well. Most of us do not have this kind of cash, or millions, or 2 millions to write this much. Okay? But if you do have the leverage, this is one strategy that you can really juice. Now, the way to cut down on this margin requirement is by going with spreads. Okay? They're called credit spreads. All right? So let's say, again, AK wants to make this bet at $1.55. He wants to buy 10 contracts. Victor is saying, no, to hell with you, man. This shit is not going to 520, and this option is going to 0. So he writes these 10 contracts at $1.55. But what else does he do? He buys something further out of the money. It's called a spread. Okay? So he buys the 530 call. Okay? And the 530 call is going for 18 cents. Now, what that is you're basically telling your broker that the max you can lose is the difference between the strike prices. Okay? 520 and 530, which is 10 points. All right? So your broker now knows that your max loss is pretty much 10 points on the stock. So they give you a break on this margin requirement, okay? But notice you're also having to buy an option at, let's say, 20 cents. So total premium that you're going to get on your spread, okay, so let's just go ahead with the spread. We got 10 contracts at $1.55, and then we're also buying 10 contracts at 20 cents, okay? Now this is the 530 call, and this right here is the 520 call. All right, so your total credit spread, meaning the max gain that you can actually make, is 155 minus the 20 cents. Okay, and that gets you about $1.35. All right, so instead of taking in $1.55 straight, you're taking in $1.35 per spread. Okay, so you have a spread of 10 contracts. Your total profit is going to be $1,350, and your margin is going to be reduced to around $10,000 or $20,000. Okay? Now, it also differs depending on your broker. All right? Plus, another thing, too, real quick, is that if you guys have, let's say, you guys got Fidelity, or you guys got Options House, or you guys got Scottrade, all these brokers are going to require different options levels. Okay? So, Fidelity, you need to apply for options level 4 if you want to do credit spreads, you want to write naked and do all that kind of shit. Options House, you're going to have to call them and say, yo, listen, this is something that I want to do. I need the clearance for you guys to allow me to make those trades. Okay? So number one thing to do if you're even interested in doing stuff like this is call up your broker, find out your margin requirements for credit spreads, for writing naked on calls and puts, and then also ask them what level of clearance do you need, and make sure you get that before you go forward. Okay? So these are the barriers. Number one, this is a big barrier to playing the options from that side. Okay? But at the end of the day, anywhere, and again, these statistics kind of get thrown around everywhere, anywhere from 50 to 90% of options, they expire absolutely worthless. Okay? It depends on who you talk to and what day you talk to. Okay? But let's go into some real examples right now. Okay? So let's take a look at this Apple. All right? Let's say you want to knuckle down a strategy on pocketing some money. Let's say Friday comes around, Thursday comes around, and you want to pocket some money on Time Decay, and just bet on some of these options going worthless. Now, number one, why would you do that? Number two, like, when is it more advantageous to write options versus actually going long them? Okay. So let's talk about these couple examples. Number one, before you want to write anything, you need to have a good idea of where the market is going. So this goes back to you understanding what stock that you're trading, understanding what kind of moves she can make, on a given day, on an intraday basis, and knowing what to expect. Okay, and then we're going to go through the options chain and start looking at some actual premium. Okay, so the first thing you want to do is get an idea of where the hell the market's going. Okay. You need to have a good idea going into expiration, meaning Thursday and Friday, so let's just talk today and tomorrow, of where the hell this market is going or could go, okay? So now what do we know? What do we know right now? We know there's a shit ton of headline risk out there. Everybody's talking fiscal cliff. It's solved. It's not. CNN is pumping rumors. There's all kinds of stuff going on. So where are we at right now on the market, okay? We're not really a short. We're not really a long. So we're kind of in la-la land. All right, And when we're in La La Land, those are the best times to actually write options because stocks aren't really doing a damn thing. So, you scroll through your Apples, your Googles, your price lines. If they're all just sitting in a tight range, that is the best time to be writing options. And the worst time to go long options because chances are your options are going to trade very badly and you're not going to make money going long those options, and it's better to just bet against them or do nothing at all, okay? So you need to have an idea of where the market can go on a Thursday or a Friday. Okay, so that's number one. You need to understand. You need to develop some kind of a bias on if the market is a long, if the market is a short, or the market is a nothing. All right. If you believe the market is a nothing, then it's game on. Okay. Now you could also play. You can also write options for directional strategies versus actually going long. Them. We'll talk about that in a second. Okay. But let's take an example of Apple. Okay. Let's take an example of Apple, and let's assume that it does absolutely nothing tomorrow. Okay, what would you do to go ahead and capitalize on that and make some money right? Okay, now let's talk about how far you need to go out of the money. Okay, so first thing you want to do is take a look at your options, okay, for whatever stock that you're watching. So in this case, we'll take a look at Apple. We want to look at both sides. We want to look at the puts, and you want to look at stuff that's in the money. So number one, find out where your stock is. Find out what the in the money amount is, and right now it's about 515. Okay, so 515 puts and 515 calls. Notice they're about the same price. Again, these are in the money options. Now you start looking out of the money. Okay, so for puts you go below, and for calls you go above. Okay, so now notice as we get further away from the money, the premiums get a lot less, and that's obviously so because who here thinks this stock can go over 530 tomorrow? Not a lot of people. I mean, this thing's got to go 15 points and then some for you to make money on this. So would you say that this is a good strategy to write? I would. The problem is, though, is that notice you're not getting that much premium here. You're not getting that much premium. So if we go back to our little notepad here, and let's say you guys wrote 100 contracts of this 530 call right here for 20 cents. Okay? You got 100 contracts. You got max profit of $2,000. Now, let's talk about the margin, though, that you need to actually do this. All right? You got 100 contracts. All right? Times that by 100 shares. You got 10,000 shares exposure in Apple at whatever price, 530. Okay? So that's 5.3 million bucks, and then your broker wants to see that you have 25% of that. So if you don't have $1 million, you can't make this. Okay? And then that's why it looks to us that the strategy sucks, right? Because I'm spending $1 million to make what, $2,000, $2,000? That sounds kind of crappy to me. But again, this is where the option writers have a little bit more advantage. Imagine if you had a pool of $50 million or $100 million or even $1 billion. What could you do? Right? You'd write the shit out of this stuff. You'd write the hell out of whatever you can get your hands on. So now let's take it to something that you and I can actually manage here. All right. So let's go to something that is a little bit cheaper. And let me get my chain back here. This thing is kind of not working. Let's see if we can get this back. Let me put it on. Okay. So as we go further closer to the money, okay, that's when the game starts for us a little bit. Okay. So let's take something like the 525 call. All right. Let's see how much that one is. So your 525 call here. Let's pull it up again. 525 call is going for 50 cents. Okay, so this thing is going for about 50 cents. Now, I want you guys to see an actual chart of how these things move and how flexible you need to be. Okay, now this is actually a Google option. So let's move over to Google so I can show you this. So this is a 715 call on Google. So let's check out Google, and you'll notice Google and Priceline, they have a little bit more premium than an Apple would. Okay, so your Google and Priceline, generally speaking, you're going to get a lot more premium on those. Okay, so now let's take a look at this. So this is a 715 call on Google. Now look at what it did during the day. Now remember, this is Thursday. So the morning, what did it do? The morning, stocks at around 708. Notice this option opened at 90 cents, and as the stock got buried, look, nobody wants to pay a damn thing for this, and then all of a sudden you got an 8-point run. Now, these are some of the things that you need to be worried about, okay? So let's say you write this option on Thursday, assuming that it's a total washout, right? And you write 60 cents, and you're seeing this thing slowly go down in price, and you're thinking, dude, there's no way in hell she's going back to 7.15, and this option is going to expire worthless. Now, you could still make that assumption, but look at this little scare right here, right? So you wrote 60, now you're down in the position. Now you're down in the position, and you're kind of scared, okay? So these things can get pretty ugly, especially if your market is doing wild stuff, okay? You don't want to write options when you have a market that is going crazy and is liable to rip or sell 100 points on the Dow because of some bullshit headline news, all right? That can throw a whole writing strategy to complete shit, all right? And it has done for me on several occasions. And these are some things that you can't plan for. Just like, you know, if many of you guys were short the market and got screwed by that ridiculous rally today, just like that, you know, these things could happen when you're writing options for time decays on Friday and Saturday, or on Thursday and Friday. So tomorrow, let's say we come in and this Google does absolutely nothing, right? Sits at around 706, 707. This option is going to expire absolutely worthless, okay? Now, you got to think, though, about making the spread, okay? So that's one thing that is going to be a necessity for a lot of you guys. Because, again, you don't have the cash available to write straight naked, okay? Well, basically what you're doing when you are writing options for time decay, you want a situation or an environment that is basically churning. You don't want these stocks to do absolutely anything. You want them to sit in this kind of range, a tight range, and most of all, you want your market to do nothing as well. You don't want to see 100 points down, 100 points up like this. This is crazy, okay? This will drive you absolutely insane. What you want to see is slow churning to one side, you know, whether it's a slow move down or a slow move up. That's what you want to see, because then you can position yourself in the correct side, okay? So let's say the SPY is trickling up for most of the day, right? And let's say the SPY is trickling up towards 142, and this is what we get tomorrow. You know, we just get a slow move higher because people are buying the anticipation that Sunday's meeting is going to be fine. Then what do you want to do? Then you go ahead and position yourself on the put side of, let's say, a Google or a Priceline or a stock that is trending higher, and you start writing the puts, okay? So you know, you pull up your options chain, and you say on this Google, okay, you know, let me go ahead and start writing the puts that are under $700 because I have a good feeling she's going to trend up for the day. Okay. Now a lot of this, to be really good at this, you got to know tape reading. You got to know tape reading, and that's again a plug for our class because again, this is the way we look at the markets. Okay. So let's take this 695 put here. You get about 40 cents in premium tomorrow. You know, if the stock opens decent, and then maybe you move into the 700 as the stock goes higher, okay? So that's kind of like a little bit more advanced stuff, but as the stock goes higher, let's say breaks 710, you move into the 700 put, and now start writing this, assuming that it's going to zero. Now remember, you got to spread it up, so you know you're going to write this 700 put, and you're going to buy something cheaper, okay? Now you're broke here where you buy it cheaper for, okay? So there's no science on where you need to put your cover for. So if you want to buy it 20 points out, so for example, if you're writing this 700 put, you can write out to the 680, you know, and just make sure you're collecting the most premium that you can. Okay, so you're not getting robbed too much on the spread. So for example, this, if you buy the 690, you're losing 20 cents on your spread right there. So let's say, you know, you write $1 and you buy 20 cents here, you're only getting 80 cents a contract now for each spread that you write. Okay? So as you go closer to the money, obviously you're minimizing the credit, the max gain that you could make on these make on these spreads. But again, credit spread writing and time decay on Thursday and Friday, and I specifically say Thursday and Friday, is a great strategy for those of you who have decent sized accounts and are looking for more consistent gains on a week-to-week basis. Okay, and you don't want to deal with some of the nonsense that the market has to throw at you. For example, today I got rocked in this Apple because I'm short everything and I'm loving the trade, right? And I'm short Apple with the 505 put. The option goes from 2 and change all the way to $4 down here, and then out of nowhere, I get stuck with this, and I end up taking, a loss on the trade. Okay, a lot of this stuff is crazy. If you're playing directional trades, it gets pretty difficult. All right, so more, on the whole, it is easier to bet against something versus going with something. Okay, but there's a lot of tricky things that you do need to account for. Headline news is obviously one of them. You also need to realize if your stock is strong along with the market. So let's say if the market's trending higher, is your stock actually trending with the markets, or does your stock doesn't give a shit what the market is doing? If your stock is weak versus a market that is bullish, and you can't be writing those puts assuming that the stock is going to trend higher. All right, you're going to put yourself in a lot of sticky situations. And writing premium, let's say $1 premium, that ends up going to $2 or $3. Okay, so things can get really, really ugly when you're writing options, guys. Because remember, your call options or your put options, they can go wherever the hell they want to. Okay, you can write an option for $1, and that shit could go to $14. All right, the last thing you want to do is be stuck in something, especially a write, because your limit, your max loss is not guaranteed. Okay, so let's talk about that for 1 second. If let's go back to our example with AK, who's buying a what was it, the 520 call on the Apple for okay, so AK's buying 10 contracts of the the $1.55. This is a 520 call. He knows that the max that he can lose is $1,500. The writer of this, they can lose a shit ton. If this option goes to $10, then you're on the hole for whatever, $8.50 on 10 contracts. So even though your max gain was $1,500, you could lose 10 grand on that position. You could lose even more. Okay, so writing options gets very risky if number one, you're naked, or number two, you don't really know how to read tape, and you don't understand where that stock could go or is going. Okay, so that's very important as well. So let's get into some questions here before we wrap it up.
Sure. Thanks, Lucci, for the awesome presentation here. Give me just 1 second. Let me pull up.
Pete, you there?
Yep, we're here. Give me just 1 second. So we got a couple guys asking, can you give an example? Like, you're saying trade for time decay, but like, what happens to an out-of-the-money option for time decay? What exactly goes on? Does it go to zero? Does it, just go to some level? What happens to in-the-money versus out-the-money options going into Friday?
Sure. I think, and you know what, guys? It's kind of a hard concept to grasp. So even though that may have been explained by what I was saying several times, like sometimes it's difficult to understand what exactly happens to an option that expires worthless. Okay, so let's just go ahead and clarify here. So again, we got this Google option, and right now we're looking at a chart of the 715. But what I'm going to do is I'm going to show you a chart of the 720. Okay, so now that's further out of the money. And let's take a look at what this option is doing. Okay. If we ever get this all up. Okay, here we go. Okay, so now notice what we're looking at here. Remember, the 715 was about 60 cents, guys, and 720 is about 20 cents. Okay. Now let's go out even further. And I think what this guy is referring to is what happens to the chart. Okay, so now when you've written a contract and it expires out of the money, okay, it expires out of the money, that means there is nothing that you need to do. Your broker doesn't need to do anything. It expires worthless, and you just get the credit for the full right, okay? And I don't know why this is not coming up, but let's try to get it. Okay, here we go. So now this is the 730 call, okay? She's trading 5 cents. All right, and why is that? Because the stock is 25 points away. There's no damn way in hell that tomorrow this thing goes to 740 and this option is actually worth something, okay? So, you know, you could basically say right now that this option is going to expire absolutely worthless. Now, if you were to write this contract for 5 cents, okay, all you would make is $5 per contract that you wrote, and then when actual Friday evening comes around and the market is closed, you don't have to do anything, okay? Your broker is going to automatically credit you for $5 a contract for whatever you wrote, and it's not going to expire, or it's not going to exercise the contract because, again, it's not in the money, okay? These are kind of basics of options. And in the money amount, let's say an option is in the money, okay? So then what happens? And I think this is what you're referring to. So let's go to the 705, and let's assume that today is Friday, guys, okay? Let's assume that today is Friday, okay? Now what the hell is going to happen to you? Let's say you wrote this option for $3.50, okay? Now remember, you wrote this option. You wrote this call option for $3.50, all right? So now what happens when your option expires worthless, okay? You get called to the stock, guys. You get called to the stock, okay? Now remember, when you buy an option, you're buying the right to buy the stock at the specified strike price, okay? And so this is all back to basic options conversation. If you write the option, you now have to go into the market, buy the stock, and then sell it to some guy at 705, okay? That's what happens, all right? So in effect, you took a loss because you had to go into the market, buy the stock at 707, and then sell it at 705. So you took your 2-point loss there. Plus, you know, you wrote 3.5, so you collect the 3.5, so it offsets some of the loss that you took, okay? So that's basically how it works when you have something that goes into the money and it expires and you still own it. Now, for all of you guys here, you do not want to own contracts or hold contracts into expiration. You don't want to do that shit, okay? Unless you want to own the damn stock, which I'm assuming not a lot of you want to do. All right, we're here to trade this stuff. We're here to trade this stuff for money. I would highly recommend that you guys do not allow any of these options, whether you're long or short, go into the expiration, whether you're in the money or out of the money. Obviously, if you're out of the money and it goes to zero, you got nothing to worry about. You got nothing to worry about. All right? But if you're close to going into the money, you better get the hell out of that thing because, you know, you're not going to have the money to suffice a getting put to stock or getting called to your stock. Okay?
And Lucci, now, that actually goes into some of the questions that there's a lot of people actually asking that when you're actually short a stock, since you're actually net short, an option, can you get called for it? And also, when you do get called, is it sort of a time frame thing? Is it a loss thing? How does that work, or is that a broker to broker kind of thing?
Great question, guys. So in my life as an options trader, okay, in my life as an options trader, whether I've been in the money option or out of the money option, I have never gotten called on that option. I have never gotten called to exercise. And you know what happens is that, let's say I got this Google, let's go back to this. Let's say I got this Google 715 call, right? And somebody just wants to exercise randomly, right? And I get assigned to that, call. Generally speaking, you're not going to get assigned to it unless the broker sees that you have the cash available to exercise, which none of us are going to qualify for anyway. So chances are, and again, I'm not saying this as 100%, you are not going to get called out of your option before the expiration, because chances are, and again, I'm just throwing this out there, chances are you don't have the money to cover the shit anyway. We're just using it as a vehicle to make money. The broker knows that too, because they look at our bullshit small accounts and see we ain't got no money in the first place. So they know they can't call us. They can't call us for it because we don't have the money to make good on the buy or sell of that stock. So to answer your question indirectly, chances are you are not going to get called. I have never, ever, once in my years of trading, have been in this. Yes, it is a random process. Yes, it is a random process. However, I personally think that's bullshit, because if it was a random process, I would have gotten picked. Assignment is a lottery. It is a lottery, but I would have gotten picked. And I think there's a fail-safe after that as well. I think there's a fail-safe that makes sure that X, Y, and Z customer who doesn't have the cash in his account anyway to suffice a buy or a short it doesn't go. It just doesn't hit, because otherwise I would have gotten hit. I would have gotten hit. Plus, as you guys are saying, it happens a few times, and yes, that's right as well. It doesn't happen that often, so I wouldn't be worried about it.
And we got another question here. This is actually a really good question. It seems that premiums get eaten up a lot on Mondays through Thursdays. Wouldn't it seem better to trade the weeklies for Time Decay on those days instead of on Fridays?
Okay, great question. Now I'm going to say no to this, simply because if you're going to trade high volatility stocks, and it all depends on what you're trading. It all depends on what you're trading. So if we go back to this Google, and let's just take a screenshot of what's going on this Google. Okay, so let's say you see a stock that is downtrending, and you want to go ahead and play a call option and write a call option because you're assuming the stock is pretty much done, pushing higher or doing whatever it needs to do, and you want to capitalize on the time decay in these options going to zero. So let's take a look at this 720 call, but let's take a look at it for the last 5 days. Okay? And now let's take a look at some of the shit that you got to deal with. And it's quite a lot. It is quite a lot. So let's take a look. Let's go to the last 5 days. So now take a look at this option. Now, obviously, all of you are sitting there thinking, like, holy crap. I could have wrote this option for $10, and this thing's going to zero, and I would have gotten $10 per contract, right? It seems simple, right? Now, here's the problem. Here's the problem. Again, if you're wrong on your trend, number one, and let's say Google is in total la-la land, you really have to be a good tape reader. You got to be a good tape reader to understand the ebb and flow of the markets. So let's say you take a look at the market, and the market has just been up too many times, and you're like, you know what, money's coming out of techs. These look like shorts to me, so I'm going to go ahead and start writing these calls that are out of the money here, assuming that by the end of the week, we're going to go nowhere. So that is a completely other strategy that I did want to just address for a couple. But again, we're talking about Thursday and Friday time decay. If you want to go Monday, you need to start trading these as directionals, okay? As you need to start understanding where the stock is going to go for that week, or at least the sentiment, okay? So if the stock is bullish, if the stock is bearish, if the stock is doing nothing, you need to be able to position yourself correctly on the right side before you actually make these trades. And I'll give you a perfect example. Let's say you wrote the let's say you wrote the puts here, okay? Let's say you wrote the puts. So let's go with the put, and let's go with let's say, what the hell, 700. Let's go with the 700. Okay. So let's say you're looking at this action right here, and you're saying, remember, none of this shit has happened. You're looking at this action, and you're saying, you know what, Google's going to 730, Google's going to 740. I'm going to go ahead and write the puts because I believe that the stock is in an uptrend. Stock is in an uptrend, and she's not going to do anything, right? So then what do you got? What do you got? You take a look at your puts here, and what are you doing here? What is really going on, right? So let's say you write 2.5 for $3. You got all these spikes to $4. The stock is looking weak. How are you still going to have that conviction down here at $700 when it looks like your stock is going into the money? This option is at $4. Remember, none of this shit has happened, okay? You don't know this stuff is going to happen, right? You're just kind of on the hook for these things. So as your stock continues to do whatever it's going to do, if you're positioned in the wrong put, or the wrong call, or the wrong put, or the wrong side, you end up getting yourself into some deep trouble if you write on a Monday or a Friday, assuming that the stock is going to do X, Y, and Z by Friday, okay? Remember, you got 5 extra days right there. A lot of shit could happen, especially in this crazy market. All right, so I'm not saying you can't do it, and I'm saying it's a very viable strategy. Problem is, you got to know your tape reading. You got to know where your market's trending. You got to know, you got to know what's going on. You have to know what's going on. You have to understand the sentiment on your stock. And to me, the only way to do that, for real, is understanding how to read tape.
Appreciate that, Lucci. There's a couple technical questions I'm actually going to answer if you don't mind. They're more risk questions. So somebody's asking about what is theta and delta. So theta just means time decay. Delta just means a position. These are all referring to your risk. So if I say I've got 7,000 delta risk, that means if the stock moves $1, I'm going to be risking $7,000 in my options position. Okay, that's what you say in risk terms. You got 7,000 delta risk. Okay, the theta This applies to, again, why you don't short on Mondays through Thursdays or Mondays through Wednesdays is because theta represents sort of like a theoretical value of how much time decay you have, meaning that if your theta is 50-50 on the spot, that means that for every day that occurs, or every, excuse me, how do I explain this? Theta is sort of like the theoretical value of your option is going to drop by $50 per day if your theta is at 50. Okay. Now, if you guys ever watch the Greeks, you'll see that on Mondays and Tuesdays and Wednesdays you have very little theta. Okay. That means that you're actually not getting a lot of time decay on those options unless you play really out of the money. The problem is, and this goes into Steve's comment. He says never sell weeklies on Thursday and Fridays. I think what you're saying is that you don't want to sell the ones that are opening on Thursdays into next week, obviously because of the weekend risk. But you should always write them on Fridays, because Fridays, we're talking about the ones that expire Friday. So you don't have more volatility risk from earlier in the week, and you have a huge theta component, a huge time decay component that just keeps going up and up and up and up, meaning that you make more money from the time decay. David actually has a question for you, Lucci. Do they still do rotation when they open up the SIBO? And
yeah, I hit him up. I hit him up privately, guys. So when an option opens up, you'll notice that an option has to adjust for the gaps in the pre-market. All right. So if a stock, let's say Apple, gaps up like crazy overnight, all the options are going to be affected by it. You know, your puts, your calls, whatever the hell it is. So they go through what's called an opening rotation. All right, so they don't open the options until every single one of them has a set opening price, and then only when it opens, your spreads are going to be so violent and so crazy off the open, because again, everybody has to adjust for now the gap overnight. So a lot of crazy shit can happen in the first 5-10 minutes. So if you're going to start writing again on Fridays, I would highly recommend to wait until the day has begun officially, 10 o'clock, 10:30, to really get in heavy on some of the spreads.
And another guy is asking here, how do you deal with headline risk, especially these days when you're writing options? And I think you should also address how market makers are going to spread it out when that happens too.
Great, absolutely. I'll let you speak. Well, today we saw it, freaking huge.
I mean, honestly, there's no real way you need to just prepare. You make sure that you don't have a lot of crap on the docket.
You guys want to see some shit? Hang on. All right, so we're going to show you the option that we were in, and how absolutely disgusting it was when when the actual headline came out. So now, the ideal way to play headline risk, my man, is to do nothing. Is to take yourself completely out of the equation and do absolutely nothing. That is the ideal way to play it and the smartest way to play it. Unfortunately, we're all traders and we're all freaking addicted. So it's probably not that viable for a lot of you to do. Now, take a look at this. Damn, come on, man. Okay. Unfortunately, you're not really seeing it here. I want to see this candles. Maybe we can get a bar chart. Get a bar? Oh, that looks terrible. No love. Oh, here we go. All right, so what happens? What happens when you have some crazy headline piece come out? Okay, what happens is the market maker retracts a lot of their bids, okay? They retract a lot of their bids. Now, they say they're supposed to provide liquidity, and liquidity is not supposed to just disappear. That is obviously bullshit. We obviously know it as bullshit because, stuff like this really wouldn't happen that quickly, okay? So what happens is, as soon as the news comes out, everybody disappears on the bid. Everybody disappears on the bid. So you'll get an option that wipes out 50 cents like that. And there was no way to even get out unless you got out before the shit even happened. And then after it already happens, you're just chasing the bid down. That's all you're doing. And you basically have to accept the fact that this bid is not coming back, okay, which is very difficult to do. This is what happens during headline risk, guys. All right? None of this stuff would happen if we're in a normal, orderly market that is not run by algos and all that kind of stuff. This is headline risk, guys. When an option, when an option on something that is trending goes from $4 to absolutely zero in less than 20 minutes. Okay? So you want to know how to play headline risk by writing options? You gotta be on the cusp. You always have to be on the cusp of what is happening. So let's say you see something unfold, unfold right in front of you. So let's say you're taking a look at the SPY, and you see this huge rip, and you say to yourself, holy shit, now people are saying, there is going to be a deal, and fiscal cliff is not a big deal. You just move over to the puts and start writing the puts. I mean, that's really how flexible you need to be if you want to write options during headline risk stuff. And the same goes if you're going long options. You need to be flexible enough to bury your short positions and get long here. But most people are still short biased. So what ends up happening? You still hold your short through all this. You get screwed on your short, and you never get a long. All right? That's just the name of the game. So the best way to play headline risk, guys, and this is across the board, you do not play. You do not play.
All right. I think that's pretty much going to wrap it up, guys. We have a couple more, more specific questions that we would love to answer for you, but we are pretty much running out of time here. So feel free to email us at lucci@sayinglucci.com or shoot us an email over at marketfi@marketfi.com. Guys, if you have any questions, we love to answer them. Again, we are options trading whizzes out here. We run a hedge fund that trades weekly options. So do not get caught up too much with too much theoretical value stuff with weekly options, because these things are very much sentiment and market maker driven. So again, guys, really appreciate you guys coming out. Feel free to hit us up. Check out our chat. We have a free chat that we run on marketfi.com. Feel free to check out our products. We're here as a resource for you guys. And again, the big thing is that options is pretty much the only space now that you can really get any true alpha on in terms of the equities market. Equities market in general is really, really crowded. It's real tough these days. So again, guys, feel free to shoot us an email and get in the option space. This is where you can make the big bucks. Put down the right risk, do the right tape reading, and you'll be on your way. Again, guys, thanks for coming out. Feel free to shoot us an email. Catch you soon.
As for the recording, guys, we'll put up a post on sayinglucci.com, and you guys look back on that, and you'll be able to find it easy.
Yep.
Alrighty?
For sure. All right, guys. Have a good night.
Have a good evening.